So when we get to the piece about, well, what makes a great investment, I go back to this issue of rate of return. You know, sometimes a great investment might be simply described as, well, it met my goal. That doesn't tell you anything. Rate of return, we say in our firm, is the bottom line of all investing. And that's a really important thing to think about. And so Rob and I were talking before this chat today about businesses that compound at 8 or 9%. And I said, 8 or 9%, when you compare it to a 1.5% interest rate on the 10-year, is pretty attractive. And everything's relative. But I think rate of return is hugely important. And so then I went to discover what the historical rates of return were in all different asset categories: stocks, bonds, art, real estate, oil and gas, collectibles, fancy cars, you name it. And when I was looking at this over maybe 70 years, now over 100 years or something like that, the data indicates that public companies in the United States have compounded at roughly between 9 and 10% a year. And that's better than all other asset categories, and it's unleveraged. And so that causes me to ask another question. And that other question is, well, why is that so? Why isn't it 3% or why isn't it 16%? And I'm not terribly mathematically inclined, and so I use the term that it correlates, but I don't do that with a mathematical background. I'm just saying I observe that 9, 10%, not too precise, approximates what these companies are earning on the shareholders' capital. That is, we refer to it simply as ROE. We look a little bit more in depth. We're talking about free cash flow return, subtracting maintenance capex and that sort of stuff on the owner's capital, the capital employed. And so I go from there to posit the following. Our return in an asset will approximate the ROE over a period of years, given constant valuation and given the absence of any distributions. So you all look up at me and you say, well, you fool, everybody knows you don't have a constant valuation in the stock market. So we just work very hard to have an attractive valuation at the start. And as it relates to compounding your capital, your opportunity for a higher rate of compounding is enhanced by a lower valuation at the start. I mean, it's just real simple. And I have a little bit of an arithmetic proof of that if you're interested. You take a $10 stock with a $5 book and $1 worth of earnings, so it's 10 times earnings, it's 2 times book, and it's a 20% ROE. And you apply that to the company and see what happens to the stock price. So you add that $1 worth of that 20% ROE, you add that dollar to the 5, you have a $6 book. 2 times book is 12. You have a 10 times earnings. By the way, it's $1.20 in earnings now. 10 times earnings is 12. So the stock price moves identically with the ROE in the business. And on a constant valuation, absent any distributions, that's sort of my very modest level of a proof of this notion. And it's a valuable notion that's served us well for a long period of time. So then my next question is, well, how is it that we identify an investment which will likely lead us to an above average rate of return? What are the characteristics and what kinds of businesses earn above average rates of return? So we say very, very carefully that we like to fish in the pond of high return businesses. And so it makes it much easier for us to get our focus up front. Is we start with the notion of what kind of returns on capital does that business earn? And I'm just do something a little bit interactive here today. If I ask Sir Rob, what is the typical net margin of an American business today in percentage terms, what would you say?
10 to 15%.
So you think it's 10, maybe a little bit above that. I'd suggest that most people answer it's probably in mid or upper single digits. All right? And an investment that we own, I'll come back around to later on, is Mastercard and Visa. And does anybody want to guess what the net margins of Mastercard and Visa are? 40. There you go. So they're in the mid 30s. And you could cut that in half twice, and at worst it would be an average business. It's extraordinary. So and I actually was talking to some people about this at the Munger meeting the other day, people who are well schooled in the market and good investors, and they had no idea. They just didn't think of it that way. But that happens to be the way we think about it because we have this little idea that our returns will be affected by the quality of the business and the rate at which it can grow the economic value per share. So, by the way, in MasterCard, I can come back to it, but it also then causes us to spend a lot of time trying to figure out, well, why is that so? What is it about the essence of that business that allows them to earn returns that cause them to have a big bullseye on their back, that everybody, all other companies want a piece of a business that has returns that are that high. So in my office, for some really unknown reason, I had on the desk an old-fashioned milking stool. And it had come to me through my father, and it had come to him through a business partner of his. And on the top of this platform, it stands about that high, and it has 3 legs. And the first 2 are in the front, and the third one is in the middle and the back, and they're splayed. And a farmer who was milking his cow would grab that back leg and sort of just stick it up under his behind as he sat down to milk a cow. This was in the old days when they did it by hand. And so I was looking at that one day, and I thought, that's actually a perfect construct for our notion about what makes a valuable investment. We call it the 3-legged stool. So if you looked at our material is resplendent with these 3-legged stools. And the first leg of that, and we just use this as a shorthand version, a construct to help us think in very simple terms about how you find these great investments. So the first leg is this issue of a high return business, an exceptional business. Mastercard is an exceptional business. The average business earns, call it 8% after tax on earnings, and Mastercard earns 34%. That's exceptional. Even if the average were 10% would be exceptional. But Mastercard's 34%. My God, it's really incredible. So the first leg of the stool that we talk about is the quality of the business enterprise, and we spend a lot of time going down this road that we call, what's the essence of this business? What is it about the business that's causing this unbelievable rates of return to occur? The second leg of the stool then goes into the operations. It has to do with the people who run the business. And the shorthand version of that is we want them to have both skill and integrity. But what we say is that they've got a demonstrated record of being just killers at operating their business. But in addition to that, they treat us as partners even though they don't know us. It's a really important idea because the reverse of that is somebody I heard described the other day is talking like Warren Buffett and acting like Ronald Perelman. And there are people out there, and you'll find them, you'll run across them, who do whatever they can to make sure that public shareholders don't get their fair share. And we don't want that. We want the same thing happens at the company level to happen at the per share level. And that these are wonderfully skilled operators as well. So first leg is the quality of the business. The second leg is really the quality of the people who run the business. And then the third leg is the issue that really helps create the value, and that's the reinvestment. And there's a book out pretty current now called Dear Mr. Chairman, or Dear Chairman. And it's about activists and companies and trying to change the behavior of companies typically because of their reinvestment histories. And if a business has a great high return on the owner's capital, we would love for them to be able to take all the free cash they generate and put it back into that business to continue to earn those high rates of return. It's way more efficient than paying us a dividend, all of those things, and that's what creates the compounding effect. And when I get around to compounding, I always use the example, you all have seen it on the web, about the penny. And so I'm going to ask this engineer right here, would you rather have in this hand $750,000 or a penny doubled every day for 30 days? So you want the penny, right? And I knew that. So instead of $750,000, I'm going to make it $2 million in my right hand versus the penny, doubled every day for 30 days. You still want the penny. So I figured that. How about $2 million one? Well, I mean, it was, this choice, it was $2 million before. You still took the penny. I'm saying, how about if I make it $2 million one?
That's a lot of money. I picked the $2 million.
Yeah, see? Now, who knows right off the top of the head what that figure is?
10.8 million.
Yeah, it's 10.8 million. It's 10,737,000 or something like that, and some change. And so the simple arithmetic is it's 100% return for 30 periods, And that's the power of compounding. And so the really great thing about compounding, I tell people, is, if you have a stock that's going up 10 times, the next time it doubles, it's going up 20. And the next time it doubles, it's going up 40 times. What? Compound interest and compound return is just, it's staggering. Actually, I have a correspondence with Warren Buffett about this, and he always has said, as it relates to compounding, either you get it or you don't. And I wrote him a letter and I said, that was not my experience. My experience was I didn't get it until I experienced it. And that goes to this whole issue of investing. I have never been able to learn from other people's mistakes. I have to make my own. And so this process is designed to help me and my colleagues and partners have focus as it relates to how we're going to invest. Contrary to that is everything you see on the TV in the morning on Squawk Box or all those things. And they have a different business model. And their business model is mostly supported by financial institutions and other consumer institutions who want your eyeballs. And if it's a brokerage firm that's sponsoring it, the definition of a broker is to create transactions, right? You're advertising people, they want to create transactions, right? And what's the best way to create a transaction in the brokerage industry? Create what I call false expectations. And the false expectations are the notion that XYZ company earns $1.37 in the quarter. And the first thing that happens when they release their quarterly reports is everybody comes out and says, oh, they earned $1.38, they beat by a penny, you better buy it. Or they earned $1.36, they missed by a penny, you better buy it. Well, if you stop and think about it, unless you're very adept at trading the market on a daily basis, it's a sure loser for you. It's bad for your economic health. And as it relates to trading the market on a daily basis, there are very powerful computer algorithms out there using all kinds of information not available to most of us that are competing against you. So I just make that observation. We try very hard to be investors in the value of businesses as opposed to speculators in the price of shares. Now, do you remember what a penny doubled every day for 30 years is? Don't lose sight of that. So we tell our clients and our prospective clients that our goal is to compound their capital at an above average rate while incurring a below average level of risk. So let's start with the back end of that. What do we mean by a below average level of risk? Well, the businesses we own typically have the following characteristics. They have more growth. They have higher returns on capital. They have stronger balance sheets and frequently lower valuations than the market. So on their face, they're less risky. It's observable. It doesn't have anything to do with volatility because our belief is volatility is a risk only in the short run. If you have an obligation in a year to buy a house or to do something like that, you probably don't want to speculate with that cash that you have set aside for that. But if it's 5 years or 3 years, you have the ability to put that money at work and have it work for you. So volatility is not in our lexicon, basically, in terms of risk. And we've already talked about what average is, and we think average is roughly high single digits, maybe low double digits. And it has to do with what the overall interest rate environment is. And so there are lots of investors, Michael Steinhardt and people like that, who retired with records of very high rates of returns. But that was against the backdrop that in January of 1981, the long bond, the 30-year Treasury, yielded 15 3/8%. And prime rate was 21.5%. So it was in a backdrop in which rates were much higher than they are currently. So returns in all businesses are lower these days. And my guess is average these days would probably be at the low end of that sort of high single digits number. And because it's an average we're talking about, it does not mean that we will have a return on any given year that's better than that. It means to us over a period of 5 years or 10 years, our returns are very likely to be well above that number. But I would say if observably, maybe a third of the years in the last 25, we maybe have done less well than the S&P, which is, we use that simply because it's available. We don't care what indices people want to compare us to. That's their choice. We spend no time thinking about that. And so I border on salesmanship here a little bit, and you can edit this out, Rob, if you want. But the record that we have accomplished for our clients, I'll just tell you I'll give you some numbers very, very quickly. Our separately managed accounts, which we've been doing for 27 years, have compounded at 12.7% versus the S&P at that period of time of 9.4%. So a little over 330 basis points over the market, compounded annually for 27 years. We have a private investment partnership that's been around for 23 years, and it's compounded it at 15.25% net to the partners versus 9.2% for the S&P during that specific period of time. So 23 years, 600 basis points over the market. We've run 2 mutual funds in our life, the FBR Focus Fund and then subsequently the Akre Focus Fund. Those 2 records combined, the number is 13.2% versus 7.7, 550 over the S&P, over the S&P for that period of time, 19 years. And then simply the fund that we currently manage, the Akre Focus Fund, which has been in existence a little over 7 years, it's 125 basis points over the market. And the market has been 13.5% in that 7-year period of time. So I just say that, and I don't print them for you, but I just say that to say this is the outcome of using this thought process in our investments. Saurabh has asked that maybe we talk a couple of minutes about some examples. And going way back into the 80s and early 90s, we invested in a company called International Speedway Corporation. And International Speedway had the characteristics of it was 12 times earnings, it was 26% return on equity. It had an owner-operator who owned 60% of the stock, and it had a lot of growth in front of it because it was the dominant racetrack owner in NASCAR racing. And they owned International Speedway in Darlington and Talladega. They went on to build some more. It's not a very attractive business in my mind today for a bunch of reasons. The man who ran it, Bill France, passed away. His daughter's taken it over. She doesn't have the same skill set that he had, but during that period of time, we made 10 to 20 times our money on that business over more than 10 years. Another company that was also in the entertainment-related business was a company called Penn National Gaming, and the way these, there's a lot of serendipity about the way these things come out. A young man who was working for me at the time, talking to another investor, said to us, well, you ought to look at the 10Q of this company called Penn Gaming. And we did. And in Penn Gaming at the time, in Pennsylvania, Sorab was in Philadelphia there, in Pennsylvania, had 5 off-track betting parlors in Pennsylvania. And they were limited by licenses in the state. There were only a total of 23 in the state. So you had a high barrier to entry because of a regulatory issue. And what was interesting in this 10Q was the 5th off-track betting location that they built cost them $2 million to build it out. And they had, $1.6 million of operating income in the first 12 or 14 months. I'm saying that's not a bad business, I took it upon myself to go meet the CEO. We talked about the importance of people. He was a real estate developer by background. His father had control of this old racetrack, Penn National Gaming, that had, because of Pennsylvania, they had given the licenses for the off-track betting to the legalized gambling arena, the racetrack, the horse racetrack business. And he was ambitious. And as a builder and developer, he borrowed a lot of money in his lifetime, and he told me that he had been able to avoid ever having his wife co-sign a loan. That's a really important measure of risk understanding. And so I got involved, and it was after that he bought another racetrack in West Virginia, about an hour and a half from Washington and Baltimore, and converted that into a casino that now has 5,000 slot machines. And he went on to become the largest non-Las Vegas, non-Atlantic City casino operator in the country. And it's another case where we made 10 to 20 times our money in our accounts. Again, this was a situation of high returns on capital, low valuation, major shareholder, owner, and operator, and a low valuation with a huge opportunity for growth going forward. And then in current times, we talked a little bit about Mastercard. Some things that are interesting about Mastercard. We purchased it originally in February of 2010, and this is when the Dodd-Frank discussions were going on in Congress after the financial crisis, and more particularly about the Durbin Amendment, which had to do with domestic debit transactions. The long and short of it is, we bought the stock on an average price of $22.20 in February of 2010. Today it's 109, something like that. So we've made 5 times our money in 6 years, something like that. And the reason was that here's a business that had fantastic returns, as we've already talked about. It had a low valuation. The valuation in February of 2010 was something like 13 or 14 times. It was growing its free cash flow per share at a rate much faster than that. And we had a good thing happen with it, that we've been to meet the new CEO, Ajay Banga, who's a Punjabi, and really bright, interesting, lovely guy. And so you and I were talking earlier about the interaction of people. And so we see him in a setting with other executives in his firm, and he's first name basis, kidding with them, they kid with him. All of these things are important, just things, I talked about reading business biography. You get a feel for how people behave and how they deal with their colleagues and so on. And so we've made 5 times our money in 6 short years in an extraordinary business. Now, if you remember what I talked about, the third leg, reinvestment, their returns are so high that they can't possibly find another place to reinvest their money at that rate and get that return. So our compounding is diminished modestly because of that. So they buy in scads of stock, they pay a dividend, they invest a lot in new technologies, all relating to what I call the electronic exchange of value. I mean, that's really the business they're in, and we don't know what form factor it will take in years, but they're well positioned in all of the things that are going on today. Another company that is relatively new to us is Moody's, And we bought our Moody's originally in January of 2012. And we paid about $39, a little less than $39 for it. Today it's $110. And so we have a case where we've made 2.5 times our money. Again, the same idea. A great business. After Dodd-Frank, the government authorized another 6 or 8 rating agencies to exist. I'm sure there's not a person in this room who can tell you the name of any of them. It's a market-driven thing. It's not regulatory-driven. And so any company that issues debt has to go out and get a rating on it. And there are really 3 rating agencies, Moody's, S&P, and Fitch. The market is divided like 40%, 40%, and 20%. Fitch has had 20% for nearly 100 years. They just can't seem to grow it any larger than that, and it's market-driven. And if you sit on the board of a company that's about to raise debt, and you go out and you don't get a rating on your debt, and you have a bad effect in the market, you have a liability. So it's a fascinating business that again, market forces allow it to have very high returns on its capital. Another company that we've been involved with for almost 10 years is a company called Enstar. And I sat on their board for 5 years because I wanted to try to understand how the business really operated. And it's a complicated business. They buy insurance which is in runoff. And that is, operating insurance companies periodically decide, well, we don't want to be in homeowners anymore. We don't want to be in long haul trucking anymore, whatever. And they run that business off, and they're required to keep assets to support those liabilities by the regulators until that business is gone. And executives in businesses like insurance who have aspirations in their career would not like to be placed in the runoff. It's sort of the back room of the business. And this group of people who started this company are chartered accountants by training, and they're headquartered in South Africa and Dublin and Bermuda and London, and they travel all over the world all the time in search of trying to find these little pieces of business. I've seen instances where they worked on a piece of business for 5 or 6 years. They're very patient, very disciplined. And when I got involved in this company in 2007, it had a record of compounding book value per share a little bit north of 20%. But it was also 3 times book. And I paid $102.90 for my first shares in 2007. And today it's worth about $195. So it's not been a very good investment. And I've essentially doubled my money, but it's taken 10 years, so that number obviously roughly around 7% compounded. But then the valuation got more attractive periodically, and in 2009, I was able to buy some stock at 56. So my return there is nearly 4 times, and that sort of stuff. And so that goes back to this issue I was talking about, your starting valuation. And when I paid 3 times book for this company in 2007, and it had a history of compounding book at 20%. Had it been able to continue to compound at 20%, I would have done much better. But their rate of return has come down, just like it has in all businesses, as we've had this secular decline in interest rates for 36 years as a backdrop. Everybody's business returns are lower, nearly everybody. And so those are sort of 3 examples of 5 examples of businesses that we own or have owned where we've had these great returns as a result of using this process, using our process of, we call it the 3-legged stool, of identifying businesses that we think are likely to give us a return that's above average